Your credit score affects almost every financial decision you make. It can mean approval for a mortgage, better credit cards, or high loan interest rates. Yet many don't realize their score could be holding them back. The challenge is that credit scores can suffer from mistakes not your fault. The Federal Trade Commission found 5% of consumers have serious credit report errors, causing higher loan rates. Disputing these errors can lead to score improvements, helping you qualify for better terms. So how many are overpaying on loans just by neglecting their credit report? The bright side? Improving your credit score is possible and quick. First, check your credit report for free. You can get a report from Equifax, Experian, and TransUnion once every year at annualcreditreport.com. Some states offer more free reports, especially if you've been denied credit. It won't hurt your score, but lets you spot mistakes or identity theft early. Next, check your credit score. Lenders assess your creditworthiness via your score. You can buy your official FICO score or access it for free from some credit cards. Knowing your score helps you understand potential interest rates and loan terms. Then spot and fix errors in your credit report. Incorrect amounts owed, unfamiliar accounts, or wrong delinquency reports can lower your score. Review your report carefully to catch these mistakes, as they could be hurting your credit history. If you find inaccuracies, dispute them. Credit bureaus must investigate and verify the information. Send a dispute letter with evidence to ensure there's a record of your request. This could lead to significant increases in your credit score once errors are removed. Paying your bills on time is crucial. Payment history is 35% of your credit score, and even one late payment can hurt it. Set up automatic payments or reminders for your recurring expenses to avoid missing payments. Pay down your debt next. Revolving debt, like credit cards, affects your score more than installment loans. Aim to pay off high-interest debts first and consider strategies like the debt snowball or avalanche methods. Maintain a low credit utilization ratio. Experts recommend keeping it under 30% of your credit limit. This shows lenders you're a responsible borrower. Consider spreading balances across accounts or requesting a credit limit increase to help manage this better. Use credit responsibly. Make small purchases on your credit card and pay off the balance each month. This builds a positive payment history without incurring debt. Keep positive accounts open to benefit your credit history length. Older accounts with on-time payments boost your score. However, if an account has high fees without benefits, it may be worth closing. Limit new credit applications. Multiple inquiries can lower your score. Only apply when necessary, especially for loans, to keep your profile strong. Consider opening a secured credit card if rebuilding credit. It requires a deposit that serves as your limit. Using it responsibly can establish a positive payment track record. Credit builder loans can also help. These loans hold the amount while you make payments, improving your score as you pay on time. After repaying, you get the loan amount back. Request a credit limit increase. A higher limit can lower your credit utilization. Ensure your account is in good standing before asking for this. Lastly, consider professional credit repair services if the process feels heavy. Trustworthy companies can help dispute inaccuracies and improve your score efficiently. To summarize, your credit score is vital. Improve it by checking your report and score, disputing errors, paying bills on time, and managing debt wisely. With these 13 steps, you can unlock better financial opportunities. Take control of your credit today. Start your journey with these steps and see your financial future transform.